You are watching Financial Wellness. I'm Randy Alvarez. Today's topic, comprehensive wealth management. With us, we have the CEO and founder of Cornerstone Wealth Management, Chris Meacham. Chris, welcome to the program.
Thank you, Randy.
Now, before we get into today's topic, tell me a little bit about Cornerstone. Who's your typical client?
Typical client, we really have two. We have a wealth management division. Those clients range from $1 million up to $40 or $50 million. We also recently, have about a year ago, opened up an investment management division for those clients from $100,000 to $1 million. We saw a real underserved market there. We were getting referrals from existing clients for those kind of clients. I hated turning them away.
Okay.
And so they don't get this kind of comprehensive services that a wealth management client gets, but we feel we can do as good a job or better job than anybody else out there, and that's been actually very successful for us.
Okay, now everybody uses the term comprehensive wealth management. How are you any different, or are you different?
A lot of times when people mention that, I think they think of a money manager who manages stocks or bonds or something like that. In our case, it's really comprehensive wealth management. We get involved in virtually every kind of financial affairs that our clients are involved in. You know, probably the best way to describe that, Randy, is I like to liken what we do to a custom home builder.
Okay.
The architect first sits down with the client, designs the blueprint for their custom home, and it's custom to their needs. Once that plan is in place, the general contractor then builds that home using independent specialists, each with their specialty, each independent, to build the home according to the architectural blueprint. So if you think that in financial terms, it really describes Cornerstone. We're the architect. We sit down with clients and help them lay out a plan that will provide financial independence, financial freedom, whatever that means to them. And once we have that plan in place, we in a sense become the general contractor.
Okay.
And we enlist the services of independent specialists, each with their specialty, and we kind of coordinate that whole process on behalf of the client comprehensively and cohesively, helping them to meet their financial goals and objectives.
Let's talk about your background before we get into the topic. How long have you been doing this?
I've been doing this for probably 23, 24 years. Before that, I was with Price Waterhouse. I'm a CPA by background.
Okay.
That's kind of, I come up through that.
Does that help you, by the way?
Very much so.
How so?
Well, I think the technical aspects, the kind of the analytical mind that not only myself, but three of us come from three of the five professionals come from the big 8 accounting firms. And I think there's just and the fourth one is an attorney. So having that professionalism and that kind of technical background, I think, really helps when we sit down with our clients to look at their issues.
Okay. Now, do you have a minimum?
We do. For the wealth management clients, it's $1 million. For the investment management clients, it's $100,000.
Now, tell me about your team.
We have 5 professionals, 2 offices, one in San Diego and then one in Mesa, which is right outside of Phoenix, Arizona. Of the 5 professionals, 3 of us come from the big 8 accounting firms. One is an attorney, and the 5th one comes from the financial services industry. In addition to that, we have 4 support staff. I've got the greatest team I've ever had to this point in the last 8 years, and they do a great job. They really help.
Okay. Now, one of the things, we talked on the telephone. A big part of what you say is it's pointless for you to chase returns. Let's start there.
I get oftentimes
That's
clients.
That's a bold statement.
It is, and I get oftentimes clients asking me, well, gee, how should we be investing? Such and such a fund or an investment has done great in the past or has done horrible in the past. And I kind of liken chasing returns.
But isn't that what it's all about, by the way?
Well, it can mean 2 things. Chasing returns can mean looking at past investments, past mutual funds or past real estate investments, and chasing those kind of returns. It's kind of like driving using your rearview mirror. You really need to be looking forward. Secondly, chasing returns can mean going after the highest return possible, and that frankly may not be in line with the objectives of the client. So what we do is we sit down and we ask a ton of questions to our clients to really get inside their head and find out what it is that's important to them and where they want to go. And they may not need higher returns. They may be able to settle for something a little more conservative, or vice versa. They may need, because of reasons, for instance, a return that would allow them to sustain their lifestyle might be higher than they originally think is the return that they want to target.
Okay.
And so you really have to look at what your goals and objectives are, not just chasing either historical returns or chasing what you think would be the returns you want to achieve. The other thing you have to be concerned about too, I think, is life can change in a moment now. With terrorist concerns and things such as that, the world has changed a lot in the last 10 years. And
so what's the answer then?
From a financial standpoint, for us, the answer definitely is diversification. That's
you
one
call
of the
it super diversification.
We call it, yes, because when I mention diversification, most new clients that come on board say, I'm diversified. I've got large cap,
right.
small cap, international
we
stocks.
all know that.
Right. That's good diversification within an asset class. What we're talking about is diversification across several asset classes. For instance.
Are there a lot of people, by the way, that think they're diversified and they're not?
Absolutely.
Really?
No question about it.
Okay.
In fact, we find that most of the time. So when we sit down and explain to them that they really need to be more diversified and invest in things such as real estate, hedge funds, commodities, managed futures, private equities, sometimes they're taken aback because those are unfamiliar areas for them, and it's territory they've never been in, and so that takes them back a little bit. But as we have a chance to sit down with them and explain why and show historically, theoretically why, and also what's happened with our clients, it has the impact of reducing risk and volatility in a portfolio, and at the same time increasing returns. It's kind of the best of both worlds.
Now, who is your ideal client? Somebody with about to retire, or somebody that's already retired with a large portfolio? Who is it?
Probably an ideal client. I'll give you the ideal client, which is different than the typical or average client.
Okay.
The ideal client is probably somebody who has come into or has quite a bit of money, $5 million or more. They are looking for a professional to either kind of turn it over to so that they can go do their thing and not worry about it, or oftentimes it's somebody who wants to bring a professional like ourselves involved and kind of act as a team, side by side, to help them work through their financial issues.
Are a lot of people still doing it themselves? 5 million or more? They're trying to do it themselves?
Probably not at 5 million or more.
But don't those people already have advisors?
A lot of times.
And what do
they
you say
will.
to those people? I mean, how do you know if your advisor is doing a great job?
First of all, I should have a second opinion, I think.
Okay.
That always helps. And secondly, oftentimes we find even if they have an advisor, it can be maybe a stock money manager, which is great, and we'll keep them in place. If it's a good money manager, a new client comes on board, we'll keep that money manager in place, managing a portion of the portfolio, but certainly not all of the portfolio. So a lot of times we see that they need more diversification, and the advisor that they currently have doesn't provide it. Sometimes we find the advisor that they're currently working with has a conflict of interest in how they advise the client. Commissions, if they're paid based on...
Well, how do you get paid?
We get paid from the client. We charge them a fee
So it's
based
under
on
management money.
assets under
So if
management.
they do well, you do well.
That's right.
So you're not necessarily selling products.
We do not sell products.
Okay.
And we think that's a conflict of interest.
So you think people that are, they can't help but be biased?
There's certainly a perception of being biased. They can be as honest as the day is long, but still there's the perception and there's the tendency, no matter how good of a person you are, is to bias it towards what benefits you rather than the client. So what we try to do is remove the conflict of interest.
Okay.
I'm a CPA by background. Independence, objectivity kind of runs in my veins. And so when I set up the company, I wanted to make sure that we had a situation where we could provide objective, unbiased advice to our clients and in a sense, sit on the same side of the table.
What do you call yourself? Financial planner, financial
Wealth
advisor?
managers.
Wealth managers.
Yeah. Investment advisors for the investment management clients, I guess, because we really don't get into the comprehensive wealth management. But for our larger and our typical clients, we're wealth managers.
Now, do people tend to stay, it's like a dentist, you go to the same dentist for the rest of your life or get your hair cut by the same, is that the way it is in your business? That means people tend to pick one person and then they stay there? And maybe that's a mistake in your...
Well, certainly for us it is. When we have clients come to us, it's a very rare case where we lose a client. That doesn't happen very often.
Okay.
But
I guess getting people to make a change is very difficult.
That's hard. Yeah, it is really hard.
So how do they know when to change?
Well,
I mean, what are the signs?
They're unsatisfied.
Okay.
Or maybe they talk to somebody, one of our clients, who asks them about or makes a comment about super diversification and the kind of things they're in and piques the interest of their friend, and they say, gee, I'd like to know a little bit more about that. Could be coming into some new money. They sell a business, they sell a piece of real estate. So now they need a professional where historically they didn't. Let me give you one example. Oftentimes they're doing it themselves. I like to use this example because this is what we're driving for. This is music we like to hear.
Okay.
About a few months ago, we were sitting down with one of our clients, been a client for about a year and a half. And at the end of our annual, we went through our annual review and went through returns on their portfolio and other issues. And at the end of the meeting, I always like to ask my clients, so what can we be doing better? Are we doing, or, are you happy? What can we be
Good
doing
question.
better?
Okay.
And he said, well, let me answer that this way. A year ago, a year and a half, 2 years ago, before I became a client, I was staying up late at night, watching the foreign exchanges, getting up early in the morning, watching the U.S. exchanges, trading my own portfolio, frankly not doing very well, losing a lot of sleep, and it was miserable. Now, I'll tell you what I do. I read a book a week and I work on my model team. And I don't even think twice about it, because I know you.
You said your clients sleep at night.
That's right.
Better than most people.
That's a perfect example. He sleeps at night. That's the whole goal. On 9/11, which was a couple of years after we started the company, I only got 2 phone calls. My father and my brother. They just wanted to see if the business was okay. No clients called.
Okay.
Market drops 400 or 500 points, which happens periodically. We don't get phone calls, because they know that this super diversification, in a sense, provides the ability to kind of bend, for the portfolio to bend and flex under all scenarios.
What about a few years ago when the market drops, 200, 400, whatever? You got to get calls there.
No, we don't. And the market dropped from 2000 to 2002. It dropped 44%. The S&P 500 was down 44%.
Okay.
Our clients were down maybe 3 or 4% before they came back in kind of worst case.
What about results? I mean, what kind of results do you get? I mean, you must keep track of this.
We do. Every client is different. So we don't really have published results like a stock money manager would. But we track our clients and kind of group them in conservative, moderate, and aggressive.
That must come up, though, when they come in. They say, what can I expect?
It comes up, and we kind of work through them. If they were the hypothetical, typical, middle-of-the-road client, what have we done over the last 8 years? What can they expect over the future? Sure, that comes up all the time.
I'll let you finish. Okay, so there's 3 different classifications, you say, as far as returns.
Right.
What are they?
Well, we kind of classify them as conservative, moderate, and aggressive.
Okay.
And the interesting thing is that the volatility with the aggressive portfolios is no more than the volatility than those with the conservative portfolios. It's measured by standard deviation, which is a technical term. But because of this diversification, the volatility is reduced significantly even for the most aggressive investors. So you can target higher returns and lower volatility and risk in a portfolio if it's properly diversified. There's really 2 things that drive the returns. Diversification. The second thing is picking the right subcontractors, if you will. I mean, you can have a beautiful architectural blueprint for a home. You pick the wrong people to build that home, you end up with a bad home. So we spend a lot of effort and time looking for and finding the right subcontractors, those right professionals to manage the portfolio, or the right.
Can you be over-diversified?
You can be over-diversified.
Because of it?
You can be over-diversified if it's leading to an inability to properly manage the portfolio. We see that sometimes.
Okay.
Where there's so much diversification, people have money in so many different places and they don't have it organized properly where they can pull the trigger and make a move quickly. Now, we've got the system honed, so that doesn't happen with us, but we see that periodically where people can be, in a sense, over-diversified only from a management standpoint, not really from an investment
portfolio. Are they ever
standpoint.
frustrated? They go in, getting a second opinion, you're looking at their money, and then you point some things out, and they're going, how come they didn't tell me this?
Yeah, in fact, probably the case that we see most is they come to us, they've got a money manager who they think has been doing a great job for them.
Okay.
And so what we'll do is we'll take the past results for that money manager. We like to take the actual statements from our clients. Maybe they've been with them for 4 or 5, 6 years. We'll take those statements. We'll do an internal rate of return based upon how the money managers performed. And oftentimes what we find is that the results of their performance are significantly worse than either the market or the peers of that money manager. And we'll educate the client, we'll show them. If they want to keep that money manager in place, that's their decision. We'll keep them in place. Maybe it's a high school friend, maybe it's a tennis partner.
Are there a lot of amateurs handling other people's money, in your estimation? Without being negative, I guess, about other guys.
Sure, I think there's a lot of people managing their own portfolios. They probably could be considered amateurs. Now, maybe they're good amateurs.
Okay.
Are there a lot of amateur money managers?
Yeah.
There's certainly I think are more now than there were historically. You've got a lot of new hedge funds. It's pretty easy to become a hedge fund manager. And so, yeah, I think there's a lot of hedge fund managers out there.
Mistakes that you see inexperienced financial advisors making?
I think lack of diversification.
Okay.
I think following...
But they're all taught that. Why aren't they doing it?
Well, diversification within their, let's say they're a stock money manager. Great to have great diversification within the stock portfolio. But it's not an easy thing to truly diversify a portfolio across several different asset classes. The only way we can do that is because we don't try to manage the money. We pick the right people, each of them managing their piece of the portfolio. For somebody to manage their own portfolio and diversify it the way we diversify an investment portfolio for a client, I think would virtually be impossible, even if they spent full time doing it.
So you meet with them a couple of times, 3 times. What happens next?
After the 3rd time, and by the way, up to this point, no cost, no obligation. So it's in the 3rd meeting that they finally make the decision. After we've had a chance to really get to know one another, they can kind of see us in action. It's at that point that they make the decision whether to go forward with us or not. What's
the #1 reason why people don't get a second opinion? Sounds like a big hassle, by the way. Taking in all your private information, giving it to a guy like you, and you're looking at it. Yeah, is that what holds people back?
I think it's a couple things. I think it's complacency, #1, and it's #2, it's lack of focus on their financial affairs. One of the frustrations we have with our clients is, some of the clients, is taking the time to really just spend a few hours a year, frankly, to focus on this, to come in and meet with us annually or twice a year. Typically we like to meet at least twice a year. And so I think some people, they just get so focused on their businesses, their careers, their life, that they just don't want to, take time to worry about this. So they get complacent and they'll stay where they are, because it's a headache to change. It can be.
So you implement a plan on that 4th meeting.
That's it. 4th meeting is really implementation. We begin the implementation, and then from there it's off and running. We meet with them at least a couple of times a year. Usually there's a few more meetings. The first 3 or 4 or 5 months we're getting to know them. They like that. It's fine with us. But then we like to meet with our clients at least twice a year. We'll meet with them as often as they want to meet.
What are the frequently asked questions they have for you on those, in those meetings?
What kind of returns are you going to be able to get me? That's probably, what can I expect? And my answer back to them is a little frustrating sometimes to them. It's, what returns do you want to focus on? What do you want to target? Because this is really driven by the client. You need to tell us, client, where you want to go with this, and then we'll design the portfolio, the investment portfolio, your financial affairs around those goals and objectives. So the other question we always get is, where do you think the market's going? And my answer is always, I don't know. And in fact, I read a great article many years ago. It's 2001, 2002, when the market was really having its problems. It was, I believe, a Harvard professor, and he said, once you come to understand that you cannot call the future, you will become a much better manager of your own money.
Okay.
And I've always believed that. We try to position a portfolio so that no matter what happens in the future, it's going to bend, it's going to flex, it's going to protect the wealth that you have, and therefore you're going to be able to sleep at night. You're not going to have to worry about it.
Don't chase returns is your message.
Well, that's one of the messages, I think, is don't chase returns. It's far more comprehensive than that. And certainly don't chase historical returns. Now, we look at those things when we're analyzing a manager, when we're analyzing an asset class. Obviously, we look at those things. But that's not the only thing you look at. You've got to look at much more than that. So, yeah, don't chase
So people
returns.
go to you based on your track record. And we've talked, I don't know whether it's compliance or not. You can't really give a number, maybe on television. But you show them that when they're there.
We do.
Do you feel like they're entitled to do better than the market?
I think they're entitled to do as well as they realistically their goals and objectives are. If they're targeting 7% return, we'll design a portfolio like that. If they're targeting 15% return, we'll design a portfolio around that. Now, one thing they have to understand, and I explain this to them, is the higher the targeted rate of return, the greater the bandwidth. So if you're targeting 5 or 6%, the bandwidth of reaching those returns is pretty small. In other words, you're not going to be much above or much below that. If you're targeting 15 or 20% or higher, the bandwidth gets much wider. For better, if you're above your targeted returns. For worse, if you're below. But that bandwidth widens. So as long as they understand what it is they're getting into and what it is the risks, then sure, it makes sense to design a portfolio like that. In addition to just the portfolio, there's a lot more that goes into the financial affairs. For instance, we interface with their CPA, their estate planning attorney, others like that, that can affect the portfolio. You want to make sure that there's tax sensitivity when designing an investment portfolio, and oftentimes we'll want to get their CPA involved in. Estate planning issues, we'll make sure that the estate planning attorney becomes part of that team as well. So it's not just, and I guess maybe that goes back a little bit to chasing returns, there's much more to managing your financial affairs than just return on investment.
You lecture on this topic as well? You do seminars?
We do 3 seminars a year, and I do speaking at other occasions as well.
And what are the topics?
How to invest your portfolio during turbulent times was one. Real estate, that was probably one of the most interesting ones. Got a lot of feedback from the audience. Real estate's kind of a hot topic. The last one we did was on psychological entrapment.
What's that?
Let's say you've been with a good friend for the last 15 years. He's been managing your investment portfolio, your best buddies, but he's not doing a very good job. But you don't want to, you need to make a change because he's not doing a good job for you, but it's very uncomfortable to make that change.
Yeah, how do you do it? What advice do you give people?
My daughter actually went through this at one point with a real estate agent, and then she wasn't real happy with, and I asked her, I said, Kelly, whose results are more important, yours or hers? And the answer was obvious, hers. Secondly, if this wasn't a good friend, would you make a move? The answer was definitely. If those are the answers to those 2 questions, as painful it is, you need to make a move.
Okay, we'll start with a second opinion, by the way, probably behind their back, right?
Right.
Okay,
yeah.
And then from there, obviously, you're able to see things, and then they could be the judge after that.
Yes. Yeah, it's always, in the end, it's the client's decision. We're just there to, kind of guide and direct them, give them ideas, and so on and so forth.
But if they're getting returns, if they're getting 8%, 10%, and they think they're doing pretty good.
Yeah.
Why would they change there?
Well, it might be that the 8 to 10% returns are fine, but maybe the volatility within portfolio, even though those are the returns they end up with, the volatility is significantly higher than it needs to be.
Okay.
Maybe they need higher returns. But
can you get those returns without the volatility?
Oh yeah, definitely.
Really?
No question about it. There are studies that have been done on this. There's no question about it. But also, our results over the last 8 years have proven out the studies as well with our clients.
Final message, though. What should somebody look for in somebody that's going to handle their money? In an advisor, financial planner, wealth manager, whatever?
Certainly somebody who has experience, somebody who has a track record, somebody who has happy clients.
So what experience, though? Define that.
Define the experience?
How long should, what do you ask them?
How long they've been in the business, and I think it should be several years, a decade or more. I think that they should have had clients through some good times and bad times, so that the one investigating, the advisor, can talk to some clients who've been with them for a long time. I always suggest that they ask to talk to a client that's left the firm to see why they left the firm. So I think experience is very important. Also, the professional licenses that they have. How diverse are they with their background?
What are your licenses?
I'm a CPA. In addition to that, I've got a real estate broker's license. I've got several securities licenses. I've got a commodity license, an insurance license. I like continuing education, I guess. But I believe that much like the general contractor has to understand really everything that goes into building a house. Maybe he doesn't have to be an expert in every particular area, but he certainly needs to know the questions to ask and the things to look for when dealing with those subcontractors. It's the same for us. We really need to have a broad diversity of understanding of the professionals in the industry to make sure they're doing their job properly. Right.
Okay, so judgment. Yeah, obviously it's hard to tell. How does my advisor have good judgment? How tough one to measure. Do you ask them, what are your results with your other clients? They must know.
Sure.
Is that a fair question?
Yep. I think that's a fair question.
Like a company average kind of a thing?
Sure. I think that's fair to ask, and it's something certainly we can answer, but I always drive back home to them. It's going to depend on what their goals and objectives are as to how we're going to handle their situation. I think it's also very important for them to find an advisor who doesn't have an embedded conflict of interest.
Meaning what?
Maybe,
products to sell.
Yeah, products to sell. And if they're, we deal with specialists or professionals that sell products for a living. For instance, insurance. That's how they make their money, and that's the way they should make their money, and that's just fine. I don't have a problem with that. But what we can provide to that is an independent professional view on behalf of the client to make sure that that insurance salesman is doing the right thing for the client. There are clients that need insurance. There are clients that don't. Those that need insurance are probably going to buy it from somebody who gets paid a commission. I don't have a problem with that. But as a comprehensive wealth manager, and for the job that we provide for our clients, we feel it would be inappropriate for us to make our living off of commissions. That's not the way we should do it.
All right. And we're out of time. But in a few sentences, if you had to summarize what you bring to your clients, what is it?
Peace of mind. I think the most important thing that most of our clients are looking for and that we bring to them is peace of mind, the ability to sleep at night and not to worry what's happening while they're asleep to their investment portfolio and their financial affairs. That's really our goal, is bringing that to our clients. And if you had a chance to talk to our clients, I know that's what they tell you. That's probably the biggest thing that we bring to them.
Great. Chris, thanks for coming on the show. Very interesting.
Thank you, Randy.
You've been watching Financial Wellness. I'm Randy Alvarez. For now, I wish you financial success.